All right, awesome. Cool. Let's go ahead and get started. Share my screen here. Today we're talking about what I think is going to be a pretty fun presentation. And we're talking about some surprising risks and findings around growing your wealth in retirement. Okay, and we're going to be primarily focusing on a risk called sequence of return risk. And this is often an overlooked risk, but will control a lot in your retirement. So we're going to talk about the downside, which when sequence of return risk is talked about, it's primarily talked about around the downside of it. But there's also some upside of sequence of return risk as well. Okay, so let's get into this presentation. And right off the start, I'm going to ask what kind of might seem like a dumb question. Okay, why do we set to grow our money, our wealth in retirement? And now everyone's in a different position in retirement, so this is going to vary quite a bit. For some people, we need to grow our money because if we just look at the assets that we have and how much time we're going to need those assets to last and replace our income, we don't have enough saved where we can't simply put that money in a bank account, a checking account, and have enough to span our entire retirement. Okay, so we need to thus grow our retirement savings. Some of us are going to have quite a bit saved for retirement, more than we need. So if we need, $20,000 a year and we have, $2 million, obviously we could probably put that money in a checking account and still be able to fund our lifestyle throughout that entire period. So oftentimes we see those people thinking, why do I even need to grow my money? Why do I need to take risks? And the answer is going to be different for everybody. What I would urge everybody to think about is having a plan to grow your money. Because again, there's this adage in retirement or in finance that you can't eliminate risk, you can only transfer it. Okay, so sometimes we see people not wanting to grow their money essentially because of the risk of growing your money. Obviously, if we grow our money, we're taking risk in order to do so. And so many times if somebody has $2 million saved for retirement, if you're trying to grow that, you might risk it cutting in half if you put it in the stock market. So why take that risk? Well, by trading the risk of growing, or by keeping your money in cash, you're essentially trading the risk of growing your money for the risk of inflation. So if you put that $2 million in cash right now, inflation's at 4 to 5%. Okay, who knows what it's going to turn out to be going forward in the next 10, 20, 30 years, but you are guaranteed to lose in safe accounts right now. Okay, so we need to grow our money to overcome things like inflation. Okay, but by growing our money, we are introducing other risks. One of which is called sequence of return risk, which again, we'll talk about a lot in this presentation, but we've learned quite a few things from building hundreds of retirement plans for clients, for prospective clients. Okay, some of it, we could go deeper into some of these points, but just very surface level. I will tell you that simulating future investment returns is one of the most important parts of the planning process. And if we think about it, this makes sense. Okay, because again, if we need to grow our money in order for our retirement plan to work out, how that growth is illustrated in a plan is paramount. Okay, we're going to talk and show a couple slides later in this presentation where a big issue that we see is people growing their money by a static interest rate. Okay, like 6%. And we're going to show how that's essentially the exact wrong process for how you should plan for retirement. It'll translate to some huge destructive errors. But again, we see a lot of issues, not only from DIYers with how they're simulating future investment returns, but also even from planners. And again, this is oftentimes why we have prospective clients that come into our office and their current advisor says their plan is totally good. Don't worry about it. They don't really show them that much detail as far as a plan, that they just kind of give them a blanket statement that your plan is going to be all right. Okay, nothing to worry about. And then we upload their plan under 1,000 different scenarios, 1,000 different simulations, and we show they might only have an 80% probability of success, which means they have a 20% probability of running out of money. And that's very alarming because again, their previous advisor told them they would be just fine. They'd be all right no matter what, pretty much. And again, that would translate, most people would think, into a 100% probability of success. So they're often surprised when that's not the case when you plan in let's call it a better way. The other thing that's fairly surprising is the retirement math is fairly counterintuitive. Again, this might seem like a weird idea, the math behind growing your money, because many of us know the math as we've been accumulating wealth while we've been working. Well, it changes when you're retired. Okay. And a lot of common and expensive errors that we see when simulating future investment returns. Number one is using just one scenario. Okay. So most of us know we can't predict the future. Okay. And even the best model for trying to illustrate what future returns might look like, if it's only one scenario, it's guaranteed to be wrong. Okay. If it happens to be right, okay, and you can consistently get the one scenario right, well, you shouldn't be financial advising or DIYing this yourself. There's a lot more money to be made by investing people's money and running a money management shop. And so using one scenario is almost guaranteed to be wrong. So if you're relying on your retirement plan under one scenario, there's a great probability that scenario is going to be wrong, and potential probability that your retirement fails because, again, you're planning under the wrong plan. You're spending more than you should, or whatever errors might show up. Another big issue is using static returns. Like we previously talked, you might think that market returns going forward in the future might be around 10%. And so you think, I'll be conservative and I'll just use static 6% in my spreadsheet. And so your investments grow by 6% each year. Well, again, unless there's a 6% CD, this isn't a realistic way to plan for retirement, to plan for investment returns. So you're opening yourself up to what's going to be called sequence of return risk, which we'll talk about here in a sec. The other big issue I have are people that use historical returns. And that might seem like a better process because, again, the past or the future should look somewhat like the past. The common saying is that history doesn't repeat, but it rhymes, right? I think that was Einstein. And that might be the case. But using historical returns, I would urge you to not use historical returns either, because the likelihood that the next 100 years looks different than the past 100 years, I think, is fairly high. Perfect scenario right now, we even use the last 30 years, looking at fixed income, bonds, interest rates, where they were at. Okay, well, if you're using the past 30 years to plan for the next 30 years, and you have any kind of fixed income, that is going to guaranteed to be wrong. Because, again, we're at some of the lowest interest rates we've ever seen. And so simulating future interest rates or future bond returns as if they were the same as they were 30 years ago, again, is almost guaranteed to be wrong. So I would urge you to not use historical returns either. So again, how can you simulate retirements and do it properly? And what kind of findings do we see? Okay, well, again, it shouldn't surprise anybody in this group. If you watch a few of our presentations, we run each plan under 1,000 different simulations. So again, not using one scenario, but looking at a wide distribution of scenarios to gain a probability of success. And notice in this plan alone, some things that we see, and this is just picked randomly from a recent plan that we just built. Their worst case scenario, they're running out of money over here in what looks to be around 2037. The best scenario is this person ending up with a terminal value of almost $5 million. And so there is a huge wide distribution. Why is that? Why is that the case? Well, again, it comes back to what's called sequence of return risk. And in these simulations, based on how this person's current plan was invested, there was going to be a wide distribution of return. So our goal as a retirement planner is to basically narrow that range. And yes, you might give up some upside in certain scenarios. Rather than the top scenario being $5 million, it might be more like closer to 4 million. But we're clearing up all of these failed returns, failed simulations in here. Okay. So here's a kind of a cherry picked scenario talking through sequence of return risk. And basically what sequence of return risk is it's essentially how the order of returns that happen to your portfolio can wildly change the outcome. Okay. And this is mainly when we talk about the distribution phase, the retirement essentially. So math is fairly easy in the accumulation phase. Here we have a 60-40 portfolio from 1973 to 1993. And that's a very odd set of years, but I cherry picked those years, but probably not from the reason that you might think. The reason I cherry picked those years is because a 60-40 had a fantastic rate of return over that period of time, 10.33% over these 20 years. Okay, and if we start with $100,000 and we're in the accumulation phase, while you're working, while you're accumulating this wealth, again, the math's pretty simple. Okay, $100,000 grows to $720,000. through this 20-year time stretch from 1973 to 1993 in a 60-40 portfolio. And again, no withdrawals here. Okay, and as you'll see, this wealth took different paths. Okay, this one started out with the blue started out behind and only caught up towards the end. Whoops, sorry about that, guys. I'm going to try to turn on do not disturb. Sorry about that, guys. All right. But notice in the accumulation phase, regardless of the sequence of returns, they end up in the same spot. Both of these trials turn 100,000 into 720,000, 10.33% return over these 20 years. And so when you enter the distribution phase and we look at the same period of time, let's say that we take 5% from our assets for withdrawals. How does that change the math? And what we'll see is it varies this widely. Okay, so we're taking systematic withdrawals, 5% starting withdrawal, increasing it for inflation. And you'll notice from 1973 to 1993, okay, taking this distribution, you end up with $0 left in this 20-year period. We know retirement might need to last 20, 25, 30, even greater than 30 years. So this person's out of money after 10 years, and they were earning 10.33% on their money. Taking half of that for withdrawals, most people would think this should turn out hunky-dory. Everything should be fine. Well, actually, this first scenario, they run out of money. But interestingly enough, if we flip the sequence of returns, that $100,000 grows to $300,000. So there is a $300,000 difference from starting versus reversing these returns. So sequence of return plays a huge role in how wealth will be built over your retirement. Again, returns were the same in both of these scenarios. We just flipped the order. And by flipping the order, their entire retirement changed. Okay. And so let's go through a few general rules of thumb. And again, this isn't, let's just back up for a second. So a general rule of thumb, the more growth that you search for in investments, the higher the risk will be. Now, again, this is a general rule of thumb. There are some obviously trade-offs and some exceptions to the rule. They aren't perfectly correlated, meaning every dollar of extra growth that you get, you have a dollar of extra risk. But in general, they're somewhat correlated. Okay, growth, raising your growth, going for a higher return will raise your risk. Okay, but even when we talk about risk is not a straight line linear thing. Okay, there's multiple different types of risk. Okay, one of those risks many of us focus on, and that's a drawdown. So in 2008, in stock market, there was a 50% drawdown. So if you had $1 million in the stock market at one point, it was less than $500,000. Many of us are familiar with the large drawdown risk. But there's also a different type of risk called volatility. And basically what volatility is, it's the roller coaster ride of your investment returns, or rather the distribution of your returns. Okay, so if we look at monthly stock returns, they have a very wide distribution. So they have high volatility. Okay, at one point, we might be up by 10% in 1 month. At another point, we might be down by 15% in a given month. Okay, the majority of these returns will come in a narrow window, but again, they will oftentimes drift outside of this window because they have higher volatility. If we look at monthly CD returns, they have no volatility. Okay, you're going to get that same interest rate each and every month. And so all of these returns show up in one column. There's not a huge distribution of returns. Okay, and so this is a very important concept, this idea of volatility, especially when you're retired. Okay, so this is a question we ask at a lot of our events. I've changed up the numbers a little bit. Would you rather grow your wealth at 10% a year in retirement or 7% per year? And again, most people look at me sideways when I say this. Well, obviously, I'd want to grow my money at 10%. I'm going to end up with more wealth at the end. And in the accumulation phase, you're completely right. Okay, so this is, we're running these results under 100 different scenarios here. So starting balance of $100,000, and during the accumulation phase, the high growth, the 10% return wins on average the majority of the times. Okay, even though it has higher volatility. The lower growth, as we would expect, ends up with less money after this 30-year period. So $100,000, and then out of these 100 scenarios that we ran on average, that $100,000 grew to almost $2.25 million. Okay. The lower growth grew to $850,000. So again, we're going to say the high growth investment during the accumulation phase is almost always the better option. And why is that? Well, it's because you have time to recover. Okay. If the market's down 50%, you can keep working. You don't have a need for that money. And many of us have higher risk tolerances because of that. And we can sit through and prudently stay invested through those large drawdowns. Well, the math completely changes when you're in the distribution phase, when you're in retirement. Okay, so let's look at this. Let's look at the higher growth result first. And so again, we're using $100,000. We're running 100 different scenarios here. We're just starting with a simple 4% withdrawal rate, growing that for inflation, tacking on a little bit extra for taxes. Okay, so we're going to assume this return is 10% a year, and the volatility is going to be 16%. So again, there's going to be a relatively wide dispersion of results because of the higher volatility. And we see that on this presentation, or on this chart here. Okay, 18% of simulations fail. So all of these red lines down here are failed simulations, meaning that this person ran out of money. And again, it's a hypothetical scenario. They have $100,000 starting portfolio. They're basically taking $4,000 a year, but you could essentially 10x this and take this as an example of somebody taking $100,000 or $1 million starting portfolio with $40,000 a year. Okay, and notice that I limited the high part on the y-axis here at 2 million, and there are some results here that go off the screen, meaning that this $100,000 turned into even more than 2 million. But notice there's a huge wide distribution of returns. Now, I would say the number one thing when I'm talking to retirees, and I'm guessing most of you on this call will agree, your number one goal in retirement is to make sure that you have enough money to basically last throughout your retirement. So, you know, even in your 90s, if I need a certain level of money, it's there. My portfolio can sustain that level of withdrawal. Okay, so sure, some of these results up here might look fantastic, but we're risking a lot. 18% of simulations fail. Okay, what happens if we invest in the lower growth asset though? Okay, here we have a 7% return and about half the volatility. And notice what happens to the distribution of outcomes. Okay, here we have the upper limit set at 1 million rather than 2 million. And all of these lines, all of these simulations are contained in this $1 million y-axis. Okay, 4% of simulations fail. So we vastly improved the probability of success here by giving up some return, but lowering the volatility. And notice here, previously you had, again, simulations where 100,000 turned into more than 2 million. Here, we don't even have a simulation where 100,000 turns into 1 million, but it meets that goal. So we're giving up some upside, but making sure your probability of success is even stronger and making sure this is more predictable. And there's some interesting things that came from this analysis. Okay, first off though, why does the lower volatility improve probability of success? And the main reason is losses destroy wealth. And the math of the impact of losses is fairly counterintuitive. So most people would, if I ask the question, if you lose 50% of your wealth because of a 2008 stock market crash, how much do you need to earn back to get to break even? And most people would intuitively say, well, I need to earn 50%. I lost 50%. Now I need to earn 50% to get back to break even. But that's not true. If we think about it, if we have $100, we lose 50%. That $100 is going to turn into $50. Okay, if we earn 50%, then we're only gaining $25. So now we only have $75. We're still down 25%. So if you lose 50%, you actually need to make 100% in order to get back to break even. Now, this might be fine, again, while you're working, because you're not taking from those assets and you can wait out that drawdown. Okay, especially if we're getting a higher return over the long term. In your retirement, though, when you're taking money each and every year from those assets, those losses essentially become even deeper. Okay, so let's say we're going to lose 50% of our wealth over a 2-year time period, and we're taking 5% from our assets. Well, in reality, then at the end of that 2-year period, rather than being down 50% as we would be in the accumulation phase, we're actually down closer to 60%, if not even more. And so at 50% of losing, we need to make 100% to get back to break even. At 60% loss, we need to make 150% to get back to break even. And so distributions are a form of a loss. I realize you're retaining that money, so you're gaining a benefit. But as far as your portfolio value, treat it just as a loss. And so this is why losses destroy wealth, especially in retirement, because again, during those losing periods, you're continuing to take additional monies from your retirement assets, thus furthering the loss, making it harder to recover. So every loss hurts you that much more. Okay, and so again, what commonalities can we find out of these failed trials in either of these simulations, high growth or lower growth? Well, interestingly enough, if we look at the failed trials, the first 10 years of performance were key. Okay, we talked about this previously in a retirement red zone Wealth Wednesday that we recorded. If you haven't seen that and are interested in seeing that presentation, just let us know in the comments. We'll be happy to tag you. But the first 10 years of performance are going to be some of the most important. They're essentially going to determine the next 20 years of performance after that. And remember, we're running a 360 months of simulation here. So 30 years of simulation. And the first 10 years performance on average in those failed trials were 4.6% lower than they were in the successful trials. Okay. Also, the first 10-year drawdowns were 10% greater than they were in the average successful trials. So if in the first 10 years on average in the successful trials, we saw a 20% drawdown. In the failed trials on average, they were 10% greater. So it was a 30% drawdown instead. So essentially the first 10 years of these trials controlled the entire 30 years. Okay. And so again, this is why we talk about sequence of return is most important. And it's most important in those first 10 years of retirement. Again, losses later in retirement when you're in your 90s don't matter as much as a loss in that first year of retirement or the second year or the third year. And again, order of returns matters. Let's keep going through some of these slides and talking through why they matter. Let's look at static growth first. And this is a big issue that I see, especially with people that DIY their retirement and build out spreadsheets. And even I've seen financial advisors build out retirement plans in this way. Okay, so again, let's say this person thinks they're going to average 8% throughout their retirement, but they're conservative. So they run their plan at a 6% portfolio growth rate. So they're just assuming year in, year out for these first 15 years, they're just going to earn 6% per year. Okay, and they're looking at taking 4% from their starting balance, growing this at 2.5% inflation. Okay, well, as we see, they can more than successfully take 4% from their assets given this sequence of return. Okay, we see this $1 million never dips below $1 million. In fact, in each given year, it's higher than the last year. So this will give retirees a false sense of confidence. This $1 million grows almost $1.25 million by the end of this period. So they think, heck, first 15 years, my money grows through this first 15 years. So even if my retirement lasts 30 years, I'm only going to be richer, right? And in fact, that's not the case. Why? Well, because the static growth is the exact wrong way to run your retirement plan. Unless you have some kind of 6% mystical CD that I don't know about, this does not simulate any real world results, despite it being slightly lower than what you think is going to be the average rate of return. We know that there's going to be variability in your investment returns. Okay. And what happens when we start to introduce some variability? Okay, well, let's take again, hypothetical scenario. We're going to still average a 6% rate of return, but we're going to vary up the sequence of return every 3 years. And we're just going to keep duplicating that every 3 years. So we're going to start with a 15% loss. Then it's going to grow by 8%, then 25%. So again, it's going to average out to 6%, but the variability in the sequence of returns makes the world of difference. So now this $1 million, now this $1 million portfolio size taking the same withdrawal, all of a sudden we see at the end of this 15 years, this person has lost $200,000 from their starting wealth. Now I realize they took income throughout this entire period, but now we see essentially a $450,000 difference from just varying returns a little bit. Again, because of sequence of return risk, order of return risk. Okay, let's go to the next scenario. And here we'll call this a bad start. So this person had returns similar to the tech bubble, where there were 3 straight years of losses, down 20%, down 15%, down 10%. But the back half of returns basically should have picked them out of this drawdown, essentially. Because again, on the back end, we see 25% return here, 22%, 28%. The returns on the back end are very good. This all averages out to be 6% rate of return. But notice what happens to the actual portfolio, the actual wealth of this person. This $1 million, same withdrawal rates. Now this $1 million turns into $400,000 by the end of this 15-year period. Okay, how will the next 15 years play out? Well, this person is at a high risk of running out of money. They've essentially lost 60% of their wealth because of sequence of return risk. Again, the only things that are changing here are the order of returns. We're keeping the same average rate of return. And from the initial situation we ran with static growth, we see that this bad start essentially translates into a loss of $850,000 from that initial simulation we ran. And so this is why it's so important to run multiple simulations on your retirement and vary the returns, the sequence of returns throughout. Because again, we see wildly different outcomes by doing so. Don't run your retirement under just one simulation. Don't run your retirement assuming a static growth rate. And I would even say, again, don't use historical rates of return. Simulate essentially new types of future, if you will. Okay, and just so you know, Safeguard Wealth Management isn't the only one that talks about sequence of return risk or is kind of fudging numbers with these with all of these simulations that we're showing. JP Morgan Asset Management, they have a great presentation they release on I believe, quarterly basis called Guide to the Markets. They also have Guide to Retirement. They have some awesome slides in here. They go one step further in the accumulation phase. And what they'll show in blue here, they have great start, bad end. Okay, so returns start out really well and then fade in the later years. They have the steadily average returns here in the gray, and then bad start, great end here in the green. So they go one step further on the accumulation phase and show contributions of $10,000 annually. Okay. And so, sorry, I'm just seeing your comment here, Bruce, but we don't control the order of returns. You're 100% right, but we can control the order of returns a little bit later. I'll show in this presentation with better planning. Okay. And so in the accumulation phase, they added contributions, ongoing contributions. And so they even see some variability here, even in the accumulation phase. The great start, bad end with contributions is actually the worst result here. The bad start, great end is actually the best result in the accumulation phase. But guess what? It actually flips in the distribution phase. So again, this is hard for many of us to wrap our heads around, but the math changes from one phase to the other. Here we see the great start, bad end is the best simulation here. And the bad start, great end is the worst. This person runs out of money before the end of their retirement. So again, sequence of return, you can run a bunch of different scenarios, but it's going to vary widely, again, based on the order of return. And that's why you run all these simulations. Okay, now oftentimes, and we're definitely guilty of focusing on this as well in these type of presentations, but proper planning isn't solely focused on the downside. Okay, when we talk about sequence of return risk, we're often talking about the downside. Okay, essentially running out of money and the type of order of returns that running out of money essentially translates to. Okay, but there's also upside problems as well. Okay, we showed when we first talked on the first slide that the worst scenario, they were running out of money in 2037, but there's also a lot of scenarios here where their wealth is growing by an incredible amount. Okay, it goes from just under $1 million to almost $5 million with all of these withdrawals. And so this upside, this distribution of returns to the upside also creates some problems as well. Now, oftentimes when I talk about problems to the upside, I hear things like, oh, first world problems, or, oh, those are good problems to have, right? And they're certainly better than having problems to the downside. But if we have solutions to the problems to the upside, we want to eliminate problems. We never want to have problems, even if they're problems to the upside. If we have solutions to eliminate those problems to the upside, we want to deal with those and implement those solutions. Okay. And so again, different problems are created as returns are better than expected. And proper planning isn't solely about downside risk. It's also about upside risk. So in this base case, this average trial 500 for this person, we see that they have some RMD problems, specifically after one spouse passes away over here with this widow trap over here in this situation, over here on this side of the graph. But even so, these are probably RMDs that we want to deal with some Roth conversions. These RMDs are pushing them up into what will be the 25% bracket and then the 28% bracket even over here in the widow trap. But again, in those distribution of trials, okay, if we are going to focus on the 20% of trials that don't work out, that you potentially run out of money and try to fix those trials, we should also be focusing on the 20% of trials where returns are significantly better than we might expect. And there's different solutions that will be implemented given those trials. So let's look at a great case. Rather than an average trial, returns are better than expected. All of a sudden, we see a real RMD problem here. Again, widow trap, really this situation is going to suffer from. That's going to push, these RMDs are going to push them up into the 33% bracket. Throughout, while they're both married, they're still being pushed up into eventually the 28% bracket. So we see some real bad tax problems with upside sequence of return risk. And so how can you deal with both downside and upside sequence of return risk at the same time? Well, we happen to be in what I've coined a once in a lifetime window of opportunity because of the Tax Cuts and Jobs Act. And so we're in a situation right now where before 2026, we are in considerably lower tax brackets, lower tax rates. And so we can actually implement Roth conversions that can benefit you both in bad downside cases as well as upside cases as well, eliminating a lot of these RMDs. Now, after 2026, it's going to get a lot more difficult to implement tax strategies that benefit you in both cases. But for the next 5 years, 4 years, I guess, depends on if you count this year, we have the opportunity to essentially implement tax strategies that work in both scenarios. So again, good problems to have, yes, as opposed to running out of money, but nonetheless, proper planning should still deal with those good problems. Okay, again, if returns are better than expected, these people are going to have some significant RMDs and be pushed into some significant tax problems. Okay, so let's talk about solutions to overcoming problems created by sequence of return risk. So yes, we can't control the order of returns, but we can control certain things in our plan. And then that will translate into somewhat controlling the order of returns. Okay, first one is bucket investing. So a big reason sequence of returns risk exists is because if we're investing in a 60-40 portfolio and we're taking equally from that 60-40 portfolio, when the market's down, we're also taking from that bucket that's just lost money. And so what I would urge you to do is break out your investment strategy into buckets. Okay, that's how we plan. I think it's very simple, very straightforward. Here's a kind of an idea on how you break those buckets up. Short-term bucket would be 1 to 2 years of income completely in cash or cash equivalents. Okay, again, we're not earning a high rate of return. Yes, we're exposing ourselves to inflation risk, but again, this is money we're going to use in the next 1 year or 2 years. From there, we want to go into this midterm bucket. This will be anywhere from 5 to 7 years of income withdrawals. And I would call this the safe growth asset bucket. And there's a lot of different assets you can put in here. Normally in the past, I'd put bonds in this bucket. Bonds are no longer in this bucket because one, they're losing to inflation just based on the yield. And then there's a ton of interest rate risk if interest rates rise, causing bonds to lose money. And so there's a lot of different things that we like in this bucket. You can synthetically create some different investing strategies. Otherwise, a no-fee fixed index annuity is a great option in this bucket. But essentially, you're capping your downside or in a no fee fixed index annuity, eliminating your downside, you're taking a lower upside return, ideally still overcoming inflation. So in this middle bucket, we're aiming to earn anywhere from 3 to 7%. Okay. And then finally, you have your long-term bucket, which would be 7+ years of income, growth assets, stocks. Okay. In most cases. And so we know if stocks fall, if we see a 50% drawdown, we have different buckets that we can take from. So we can overcome order of return risk through bucket investing. Okay. So what would this look like? Well, in a rising market like we're currently in, we might be solely taking from this long-term bucket. Why? Well, as the market's reaching new highs, again, that's the perfect time to take from that long-term bucket. The worst time would be in a falling market. So what would things look like in a falling market? Well, in a falling market, we'd want to take from this bucket first. That's the reason we have this cash equivalent bucket. We'd want to take from the midterm bucket second if the market drawdown lasts more than 2 years, and potentially even move, in a cheap enough market, move assets from the midterm bucket to the long-term bucket. Get more aggressive while the market's cheap. We're doing a lot of that during COVID, during the 35% drawdown. And so in this way, you can control your order of returns, because again, order of return risk comes from large losses in years, and especially those first 10 years of retirement. Well, if you're set up in this type of bucket strategy, we know that even if year one we see a major decline in the market, we have essentially, depending on how you count it, anywhere from 5 to 9 years, let's say, of time where we can take from other buckets and let this bucket recover, thus eliminating that order of return risk. And yes, you're giving up a little bit of upside, but that's only known in hindsight, right? If the market just goes straight up for the next 30 years, well, yeah, we should have had all of our money in the long-term bucket, but that's not really prudent. It's not prudent to look in hindsight and determine how good our decisions were there. Okay, we have to look at all distributions of outcomes, knowing that there's different probabilities for each of those distributions, and plan accordingly. Okay, the other way you can plan and overcome order of withdrawal risk is essentially use Social Security strategically. And in the same way we're using these buckets, we're trying to duplicate an accumulation phase. We can use Social Security to kind of duplicate an accumulation phase as well by lowering our withdrawal rate. So I just grabbed this from a plan that we built. Their situation isn't as important. The details of their situation isn't as important as just the general idea of their situation. Okay, so I even kind of cut out some of these rows in this this table to just try to give you the information that matters here. Okay, so they're in a situation where their total income need with taxes is going to be $125,000. I sliced off a pension that they had, so that's where this kind of random $5,000 is coming from. And notice they're planning on delaying Social Security to full retirement age and then to age 70. And there's a little bit of a spousal add-on, so you'll see this spouse's benefit go up once the other spouse has filed for Social Security. But in a perfect world, there's a lot of reasons we want them to delay Social Security. Roth conversions, saving on taxes throughout the length of their retirement. They're getting an 8% increase in benefits for every year that they delay past full retirement age. So there's a ton of great reasons for this couple to delay Social Security. But what happens, if in a perfect world, if the market keeps going up, we're going to continue with that delaying Social Security strategy. But what happens if we see a market crash here in 2022? Okay, again, well, they're taking significant withdrawals right now. Essentially, they're taking $120,000 from their $2.2 million in assets. So that's somewhere around a 5% withdrawal rate. Check my math. But essentially, they're taking huge withdrawals. And so if their investments, rather than being 2.2 million, cut down to 1.5 million, all of a sudden we've really introduced some order of return risk. Well, how can they overcome it with Social Security? Move their Social Security filing earlier. Okay, again, they're going to give up some of this $50,000 benefit because they're not going to get that 8% credit anymore. Well, let's say that's even $45,000 at that point. Well, they've just eliminated almost half of their income need or their withdrawal need from moving Social Security up and using Social Security strategically. So now they're taking far less from their retirement assets. So they might, if they were taking 5% before, now they might only be taking 2.5%. So this, coupled with the Social Security or with the bucket strategy, I think is a really great way to overcome this order of return risk through your plan. The downsides of this bucket strategy I covered, but I didn't really point it out. The downside is, in hindsight, it might not look like it's the best strategy. Outside of that, I think this bucket strategy is fantastic. If you think there's other downsides to this strategy, throw it in the comments. I'd be more than willing to talk through it. What are some downsides of using Social Security strategically? Well, the downside that I see is a lot of people want to take Social Security early. It feels good from a decision standpoint. It means you're taking less from your assets. Many people think that Social Security is broke and thus they're going to receive cuts in the future. So the downside is I feel like showing this as an option, more people are going to pull quicker of a trigger on taking Social Security early at the earliest downturn. Okay. And so be careful with using this strategy strategically. Get some expert help on whether it makes sense, even during a drawdown, to move your Social Security benefit filing strategy up earlier. Okay. Obviously, you're foregoing, by moving it up earlier, you're foregoing a lot of things. You're foregoing those 8% increases. You're foregoing the tax benefit over your entire retirement. You're foregoing using better Roth conversion strategies in those first 5 to 10 years of retirement. Now, if you're in a market downturn, well, that makes a Roth conversion more valuable, because if your investments are down 25%, well, you can convert that much more and have that recovery take place in your Roth. So Roth conversions still become fairly valuable in downturns. Okay. The third and final one we'll talk about is dynamic spending. Okay. And this is a little bit of the Wild West on the planning front, mostly because there's not that much research, and the research that's out there on dynamic spending is not very good. Okay. From a financial advisor standpoint, there's really no off-the-shelf planning software solutions that adequately illustrate dynamic spending. So what do I mean by dynamic spending? Well, starting out with a specific income goal, and then raising that goal based on how well your investments do. So if in the first 5 or 10 years, your portfolio is in the top 10% of original simulations, okay, you can probably prudently grow your spending accordingly. Now, by how much will depend on a lot of different factors. But if you were spending, if you were pulling $50,000 from your assets, and after the first 10 years, even if we've had a downturn, you're still in those top 10% of original simulations, you could very likely increase that withdrawal rate to maybe $100,000 and get the spending increase and also still stay in a high probability of success. Now, the reason I say this is kind of the Wild West, again, is because there's not that much research done on this. I'm programming some things on the back end and playing around with this dynamic spending idea. But again, you need to be very careful when using this dynamic spending, because obviously the upside, if your portfolio is in those top 10% of simulations, what happens if they're in the bottom 10% of simulations? Are you willing to cut that spending? Because dynamic spending basically means you have to increase it when things are going well and decrease it when things aren't going as well. Now, this might be difficult for some people to do in reality. One, because it's going to tie your emotions directly to your investment portfolio, because your spending gets to go up if your investment portfolio does better. Well, all of a sudden, if the market's up 10%, we feel really good. When it's down 10%, we feel that much worse, because that might mean a cut to your spending. And so again, I would be careful with this dynamic spending, but again, I have to bring it up as a solution to order of return risk, because again, by lowering your spending when investment returns are worse, theoretically, you should be lowering the probability of failure when those returns are worse as well, because you're lowering that spending. So again, there's a lot of downsides to this strategy. There's not a lot of research on, what dynamic spending kind of constraints to have. And so just be cautious with using this strategy. Okay, so let me know if you have any questions throughout this presentation. I know I went pretty fast. We could go if you guys like these type of presentations where we're digging into the math even more, I'd be more than happy to record and dig even further. Tony always lets me know that I'm a little bit of a nerd around this retirement stuff. So I don't want to nerd out and go way too, not over anybody's head, but more so digging into data that doesn't apply or is very kind of obscure. So let me know if you like this kind of stuff, and I'd be more than happy to record some more Wealth Wednesdays on it. But in summary, financial math changes significantly in retirement. Accumulation math versus distribution math are worlds apart. And we see that because of sequence of return risk. The first 10 years of your retirement are some of the most important. So using a bucket strategy, using Social Security strategically to overcome order of return risk is paramount. And as we're overcoming sequence of return risk, think about your plan as a whole. There are ways to minimize sequence of return risk without putting all of your money in cash or bonds. Okay, again, you're not eliminating risk in those scenarios. You're transferring risk. You're transferring the risk of loss, a significant loss in a short amount of time, to the risk of significant loss over a longer period of time because of inflation. And so again, know that risk can primarily only be minimized and transferred. It can't be eliminated. So let me know if you have any questions or comments. Thanks, Bruce. I appreciate the comments. Bruce said I really like this one, would like more. Awesome. If there are people in this group that want to nerd out as much as I do, those are some of the most fun presentations for me to create. So thanks for watching, everyone. Hope you learned a lot. We'll be back next week with our next Wealth Wednesday. Oh, and if you're watching this on YouTube, after we've already recorded this, you're watching a replay, don't forget to hit the like button, hit the subscribe button if you like our content. We release content each and every week on our YouTube channel. It's growing fast, and we would love you to be part of our community. Thanks for watching.